Let's cut through the noise and get straight to the point. In the complex world of personal finance, there is one number that holds more power over your daily life than almost any other. We're talking about your credit score. And to put it bluntly, it's one of the most critical numbers in your entire financial life, period. Now I get it. For a lot of people, the term credit score brings on a wave of anxiety. It feels like this secret code, written in a language only bankers and lenders understand, so it's easier to just ignore it, hoping it will all work out. Maybe you think it's only for people making big money moves or that it's too complicated to even bother with. But I'm here to tell you, that is one of the most costly financial mistakes you can make. Think of this three-digit number, typically ranging from 300 to 850, as your financial gatekeeper. It stands silently between you and many of your biggest life goals. It's the gatekeeper that decides whether you get the keys to that dream apartment in the perfect neighborhood, or if you face another frustrating rejection email from a landlord. It's the gatekeeper that determines if you can get an affordable loan for a safe, reliable car to get you to work and your kids to school, or if you're stuck with a high-interest loan for a car that might break down when you can least afford it. And most importantly, it's the gatekeeper that holds the power to approve or deny the mortgage for your first home, delaying your dream of ownership for years. But its influence doesn't stop at loans. The reach of your credit score has expanded far beyond the bank. Need to set up electricity or internet in your new place? Utility companies may check your credit. A low score could force you to pay a hefty security deposit just to get the lights on. Even your job prospects can be affected. A growing number of employers, especially in the financial and government sectors, pull a version of your credit report as part of the hiring process. They see it as a measure of your reliability and trustworthiness. So, let's demystify it. The simplest way to think about your credit score is as your financial report card. It's a snapshot that summarizes your history of handling credit and debt for lenders, landlords, and other decision makers. It's their quick glance guide to how responsible you are with money. A high score, say 750 or above, doesn't just whisper, it shouts, "This person is reliable. They have a proven history of paying their bills on time. They manage their debt wisely and don't overextend themselves. You can trust them with this loan, this apartment, this policy." On the flip side, a low score sends up a red flag. It whispers a warning, proceed with caution. This person may have a history of late payments, maxed out credit cards, or even defaults. They might be a financial risk. It's not a personal judgment, but a statistical assessment of risk. Now let's talk real money. The most direct impact of your score is on the interest rates you're offered. This single number can be the difference between getting a car loan at a prime rate of 3% or a subprime rate of 18%. On a $25,000 car loan over 5 years, that 3% interest rate will cost you about $2,000. But the 18% rate, that will cost you over $12,500 in interest alone. That is more than $10,000 of your hard-earned money vanished into thin air for the exact same car. Now let's scale that up to a mortgage. On a $300,000 30-year home loan, the difference between a 6% interest rate and a 7% interest rate might seem small, but that 1 percentage point, dictated by your credit score, will cost you over $64,000 more in interest over the life of the loan. $64,000. That's a brand new car, a child's college education, or a significant boost to your retirement savings. Every extra dollar you pay in interest is a dollar you can't use to build your own future. That's money you could have invested, building wealth for your retirement. It's money you could have saved for an emergency fund that provides true peace of mind. It's money you could have used for a once-in-a-lifetime vacation with your family. A good credit score isn't just about saving money, it's about creating opportunities. And the financial drain from a poor score doesn't stop there. Many insurance companies use a credit-based score to help set your premiums. A lower credit score can directly lead to higher car and home insurance bills every single month. Thinking about getting the latest smartphone? A great score means you can walk out with that $1,000 phone with zero money down. A poor score? You might be asked for a hefty security deposit just to open a new line of service. So now that we know how deeply your credit score impacts your life, let's clear up a few damaging myths. First, checking your own credit score will lower it. This is completely false. When you check your own score, it's a soft inquiry. You should check it regularly without any fear. Second, you need to carry a balance on your credit cards to build credit. Another costly myth. You do not need to pay a single cent in interest. Paying your balance in full and on time every month is the golden rule. And finally, the idea that closing old, unused credit cards is good financial hygiene. This can actually hurt your score by shortening your credit history and increasing your credit utilization ratio. Understanding these truths is the first step. Your credit score isn't a grade on your self-worth, it's a tool. And by the end of this video, you'll know exactly how to use that tool to build the financial life you deserve. So, what exactly is this mysterious number? Let's break it down simply. A credit score is a number between 300 and 850. It predicts how likely you are to pay back a loan on time. It's a risk assessment tool for lenders. Higher score equals less risky. A score of 750 or above is generally considered excellent. You'll get the best rates and terms. A score below 600 is considered poor. Borrowing becomes harder and more expensive. It's not personal, it's just business for the banks. This score comes from your credit reports. You have 3 different credit reports: Equifax, Experian, TransUnion. Think of these bureaus as giant financial libraries. They track how many credit cards you have, they track your payment history on cards and loans, they track how much debt you're carrying, they track how long you've been using credit. Your credit score is the summary on the front cover of your financial book. There are 5 main ingredients in your score recipe. Payment history, about 35%. Do you pay on time? Amount you owe, about 30%. Credit utilization. Credit utilization compares what you're using to what's available. Length of credit history, about 15%. Now for the big question, the one that brings so many people here searching for a financial lifeline. It's a question often born from urgency. Maybe you've just found the perfect house, or your car has broken down and you need a new one now, but your credit score is standing in the way like a brick wall. You don't have months to fix it. You need a change, and you need it fast. So, can you really, truly see a massive 100-point boost to your credit score in just 24 hours? The short answer is yes, it's absolutely possible. We've seen it happen. But, and this is the most important part of the entire video, it depends completely on what's currently holding your score down. This isn't a magic trick that works for everyone in every situation. Think of your credit score as a long-term reflection of your financial habits. Things like a history of late payments, a bankruptcy, or collections accounts are deep-seated issues that take time and consistent effort to overcome. You can't erase years of history in a day. Similarly, if your credit report is already pristine and your score is, say, a very respectable 780, you're not going to suddenly jump to 880. Firstly, because the common scoring models like FICO max out at 850, but more importantly, at that high level, points are gained in small, hard-fought increments, not giant leaps. The biggest and fastest jumps are reserved for people whose scores are being artificially suppressed. This happens when a recent, temporary action makes your credit profile look much riskier than it actually is. It's a snapshot in time that's misrepresenting your overall financial health. Think of it like a kink in a garden hose. The water pressure is fine, the source is strong, but a single temporary blockage is stopping the flow. Once you find that specific kink and straighten it out, the water, or in this case your score, can flow freely again. So, what are these kinks? By far the most common scenario where a rapid boost is possible involves your credit utilization ratio. This single factor accounts for a massive 30% of your FICO score, making it the second biggest piece of the pie after payment history. And crucially, it's the one you can change the fastest. Your utilization ratio is simply the amount of revolving credit you're using compared to your total available credit limits. Lenders see a high ratio as a sign of financial distress. Let's walk through a clear example. Imagine you have one credit card with a $2,000 limit, and you've recently made a large purchase or carried a balance that has maxed it out. Your statement closes and your issuer reports that $2,000 balance. At that moment, your credit utilization is 100%. To the scoring models, this is a huge red flag. It makes you look like you're overextended, desperate for cash, and living on the financial edge, even if you plan to pay it off in full. Now here's the fix. If you were to suddenly get a bonus, use your savings, or otherwise find the means to pay off that entire $2,000 balance, your utilization would plummet from a dangerous 100% all the way down to 0%. While the ideal is under 10%, dropping it this dramatically is like flipping a switch from high risk to low risk in the eyes of the algorithm. This one single action could easily cause your score to leap up by 50, 80, or in some cases, even over 100 points. But here's the secret to making it happen in 24 hours. Your score only updates after the card issuer reports the new, lower balance to the credit bureaus. This typically only happens once a month after your statement closing date. So if you pay off your card today, you might have to wait 3 or 4 weeks to see the score change. To speed this up, after you make the payment, you can call your credit card issuer and ask them to do an off-cycle or interim report of your new balance. Not all issuers will do this, but many will as a courtesy. If they agree, they can report the new zero balance almost immediately, and the change could be reflected on your credit report and in your score within 24 to 72 hours. That is the key. There's one other, less common scenario for a super fast boost: correcting a major error through a process called a rapid rescore. Let's say your report incorrectly shows a maxed out card or a late payment that never happened. If you can get proof from the creditor that the information is wrong, a mortgage lender or broker can submit that proof to the credit bureaus for an expedited update. This can correct your score in just a few business days, potentially unlocking a loan approval. So, while it's not a universal solution, a dramatic near-instant credit score increase is a very real possibility. It's not about magic. It's about understanding the mechanics of your score and strategically targeting the factors that can change the fastest. For many people, high utilization is precisely that kink in the hose, and fixing it can change your financial picture overnight. Your first mission, and this is non-negotiable, is to get a copy of your credit reports. You can't fix a problem you don't know exists. Think of this as getting a map before you start a treasure hunt. You are legally entitled to a free copy of your credit report from each of the 3 major bureaus: Equifax, Experian, TransUnion. The official place to get them is annualcreditreport.com. Don't get fooled by other websites that promise free reports but then try to sign you up for a paid monthly service. When you get your reports, don't just glance at them. Become a detective and scrutinize every single line item. Start with your personal information. Is your name spelled correctly? Are all the addresses listed actually places you've lived? Watch for mixed files, accounts that belong to someone with a similar name. Next, move on to the account section. Loan credit card. Do you recognize every account? Is there an old student loan you paid off that still shows a balance? Pay extremely close attention to payment history. Look at the grid of boxes showing on-time or late payments over the last 24 months. Spot any reported late payments, especially where you know you paid on time. A single 30-day late can drop your score by dozens of points. Make a detailed list of every inaccuracy, bureau, account, and exactly what's wrong. Once you have your list of errors, it's time to take action. Finding a mistake on your credit report can be frustrating, even alarming. But it's crucial to channel that energy into a productive next step. Think of this not as a setback, but as an opportunity to take control of your financial narrative. You've moved from being a passive observer of your credit history to an active participant in shaping its accuracy. This is a pivotal moment. Simply knowing the errors exist does nothing for your score. You have to formally dispute them. An uncorrected error can linger on your report for years, silently costing you thousands of dollars in higher interest rates on loans, credit cards, and mortgages. It can even affect your ability to get a job or an apartment. The only way to fix it is to officially challenge the information. This process involves contacting the credit bureau that is reporting the incorrect information and telling them it's wrong. Remember, you must dispute the error with each bureau that is showing it. An error on your Experian report won't be fixed just because you disputed it with TransUnion. You have to tackle each one individually. You have a powerful ally in this process: federal law. Under the Fair Credit Reporting Act, or FCRA, the bureaus are legally obligated to investigate your claim, usually within 30 days. This isn't a courtesy they extend, it's a requirement. The clock starts ticking the moment they receive your dispute. In some cases, if you provide additional information during the investigation, they may take up to 45 days, but the initial time frame is a firm 30. Once they receive your dispute, the bureau acts as an intermediary. They will contact the creditor that provided the information, the bank, the credit card company, the collection agency, and ask them to verify it. This is the crucial step. The burden of proof is not on you to prove your innocence. It's on the creditor to prove their claim is accurate. If the creditor can't prove the information is accurate, the bureau must remove the item. Why might a creditor fail to verify? The reasons are many. They may have lost the original records, especially if the debt is old. The debt might have been sold to a new company that didn't receive the proper documentation, or it could have been a simple clerical error that they have no record of. Furthermore, if the creditor doesn't respond at all within the investigation period, the Bureau must remove the item. For some large, overwhelmed companies, the effort required to dig up old files and respond to a dispute simply isn't worth their time. Their silence works in your favor. The best way to file a dispute is online through the Credit Bureau's website. Each of the major bureaus has a dedicated portal for this: Equifax, Experian, and TransUnion. This is generally the fastest method, providing an instant digital record of your submission. You can also dispute by phone, though it can be harder to track, or by mail. When you file, be as clear and concise as possible. The person reviewing your case is looking at hundreds of disputes a day. Make their job easy. Avoid long, emotional stories. Stick to the facts. State which item you are disputing and why you believe it is an error. Use a simple, direct template. For example, I am disputing an item on my report. The account from XYZ Bank, account number 12345, is showing a 30-day late payment for March 2025. Then, state the correction: this is incorrect. I have never made a late payment on this account. Please investigate and remove this inaccurate mark from my credit file. That's it. Clear, factual, and direct. If you have any proof, like a bank statement showing the on-time payment, upload it with your dispute. This strengthens your case immensely. Other powerful forms of proof include a letter from the creditor admitting the error, a canceled check showing payment, or court documents if the error relates to a public record like a bankruptcy. But here's a common myth: you don't always need proof. If you don't have documentation, you can still file the dispute. The creditor is still legally required to investigate and verify the item. For more serious errors, like a mixed file, where someone else's financial data is on your report, or a fraudulent account resulting from identity theft, you need to escalate your approach. For these, send your dispute via certified mail with return receipt requested. This creates an undeniable legal paper trail, proving when you sent the dispute and when the Bureau received it. For any case of identity theft, you should also file a report with the FTC at identitytheft.gov and include a copy of that report with your dispute letter. When the Bureau completes its investigation and removes the error, this is where the magic can happen. You'll receive a notification of the results, and you should see the correction on your credit report shortly after. This single action can lead to a significant jump in your credit score, opening doors that were previously closed. This next step is one of the most powerful and fastest ways to influence your score, and it's all about tackling your credit utilization. Remember, this ratio makes up 30% of your score. The goal is to get the balance on each of your credit cards as low as possible, ideally below 10% of the credit limit. But here's a pro tip that can give you an extra boost. Focus on paying off cards with small balances first, even if they don't have the highest interest rate. This is sometimes called the snowball method. While it might not always be the best strategy for saving money on interest, it can be incredibly effective for quickly improving your credit score. Here's why this works. The scoring models look at both your overall utilization, total balances divided by total limits, and your per-card utilization. Having several cards with high balances, even if they are small balances, can hurt your score. For example, having 3 cards with a $500 limit each, all with a $450 balance, looks worse than having 1 card with a $5,000 limit and a $1,350 balance, even though the total debt is the same. By paying off those small balances completely, you change the number of accounts that are reporting a balance. Going from 3 cards with balances to 0 cards with balances is a significant positive change. Here's a strategy that feels a little counterintuitive, but is incredibly effective for improving your credit utilization without paying down a single dollar of debt. You can simply ask your credit card companies for a credit limit increase. Think about the math of the utilization ratio. It's your balance divided by your limit. You can lower that ratio by either decreasing the numerator, which is your balance, or by increasing the denominator, your limit. While paying down your debt is always the best long-term financial move, getting a credit limit increase is a fantastic shortcut for your score. For example, let's say you have a credit card with a $2,500 balance and a $5,000 credit limit. Your credit utilization on that card is a dangerously high 50%. This is well above the recommended 30% and is likely dragging down your score. Now you call your credit card company or go on their website and request a credit limit increase. If they approve you for a new limit of $10,000, your balance is still $2,500, but now your utilization has instantly dropped from 50% to a much healthier 25%. You didn't have to spend weeks scraping together money to pay it down, you just made a 5-minute phone call. Most major credit card issuers make it incredibly easy to request a limit increase. This is perhaps the most powerful hack of all for someone with a limited or damaged credit history, and it can work astonishingly fast. The strategy is to become an authorized user on a credit card account belonging to someone with a long and positive credit history parent spouse. When you are added as an authorized user, the entire history of that account, its age, its credit limit, its perfect payment history, is often added to your credit report. This can be like getting a massive instant infusion of good credit. You don't even have to use or possess the physical card. Imagine your credit history is only 2 years old, and your highest credit limit is $1,000. Parents. 20 years old account $20,000 credit limit, never missed a payment.